This is another Thirsty for Knowledge Thursday, the weekly webinar series brought to you by the Ares Foundation for Financial Education. I love this topic. It is sell in May and go away. Because when you look at going back to the history and time, to the start of the markets, the best 6 performing months of the year are November through April. The worst 6 performing months, when you do the simulations over and over and over again, are May through October. And so it was sell in May, go away, come back again on, it's supposed to be all, not Halloween, it's all whatever, St. Eve's Day or All Hallows Day. Terms that have been tossed around for the last year, right? A correction, just because we're going to talk about that going forward here, is just a downturn, a decline of 10% from the 52-week high. That's a correction. So whenever anybody says the market is in a correction or it's due for a correction, they're talking about a 10% decline from the 52-week high. Now for this market, the 52-week high was just last month. So it was April is when we were in that 52-week high. The bear market is a 20% decline. A recession is when we've had 2 consecutive negative quarters of GDP, or a fall in the GDP, and gross domestic product, just for that. But the one here that's a little bit interesting with this has been inflation, right? Because you're hearing inflation constantly right now. You had an increase, a jump in April with the inflation rate, which sort of got everybody a little bit squirrely because that was the information. You saw the market downturn yesterday, Greg, where it was down, off a bit. That was because the numbers were released and they said, whoa, it's way higher than it should have been. What's going on? Is this, an indicator of what's going? And what the Fed is trying to say is, wait, pump the brakes on that. It was really like 1 or 2 specific sectors that had that jump increase versus the overall market itself. Let's wait and see what May and June numbers jump to or come out at. And was this just an outlier? But so how did we get here? So we're going to go back to the housing bubble as sort of call this as terms of what happened. Prior to that, every now and then the Federal Reserve Bank, and I'll call them the Fed going forward to make it easier, the Fed really doesn't say too much in all of their press releases and everything that they do, but every now and then they do release stuff and do say things, and it's like that's what they're talking about. Well, the Alan Greenspan thing was, he literally said, home ownership is the American dream. Or the American dream is, a part of that is home ownership, like telling everybody to go out and buy a house, which ultimately is what everybody tried to do, and we spun out of control from there. So what happened afterwards, you had Mr. Ben Bernanke come in, and he says, I want to say it was like 2011, 2012, don't quote me on that, I'm just, paraphrasing in terms of what's going through there, but he basically says, right now, because of quantitative easing and where the interest rates are, you are not going to be able to earn your money anywhere else except for in the stock market. And that's what happened for essentially, a historic bull run, right? This was the longest and strongest bull run that ever took off. And what you have here is the 2007 decline, and then the bull run that ran for the next, that's 10 years. It kept running after that, but it kept going here. But it's the fact that they were, no matter what happened, every time the market was in a position to really take a beating or take a downturn, it shrugged it off because money kept flowing into the market. And that's the lesson from last year. We had an economic global shutdown. We had a pandemic happen on a worldwide basis. The market, granted, it dropped 30%, but then it shrugged it off. Is the Campbell-Shiller, the price to earnings, the 10-year average, it's also called the cyclically adjusted PE, otherwise known as CAPE, C-A-P-E, ratio. And, the idea is that when you're looking at stocks and performance, you're looking at the price to earning ratio. Well, all that was being done and what this sort of takes into is just uses the S&P. It uses an index, but in this case, it uses the very, very broad S&P 500, and it aggregates it. As the index, it wants to generate a price-to-earning ratio for it. And the problem with that is that usually when the price-to-earnings ratio is low, that signals a buy. What happens, though, is sometimes when we have dramatic downturns like last year, not only is the price-to-earnings ratio low, but also the valuations or the dividends might be up there. And so what you get is you have this overweight where it will look like a bad time to buy when actually the stock price has dropped dramatically. So what the CAPE ratio does is it takes it and it averages out for a lot of those factors. That's the idea. It takes a 10-year average, it includes inflation adjusted, and that's what the adjusted ratio means. So basically it breaks it down so that the current price is divided by the average earnings over the last business cycle rather than just one good year or bad year, if you will, right? Here's the thing with this, but here's the thing. The reason this is important is that when this number, this PE ratio, gets over 30, it's an indicator that bad stuff is coming. On March 8th, it hit a number of 36.8. It has not been that high, right? Once. It's only once in the history of the Case-Shiller index, because they went back all the way to the start of time, that it ever hit that high, and that was in 1998, right before the dot-com bubble. The 2007 to 2009, the housing bubble, right? But this particular slide is indicated, if you go back and look at the financial collapses, and collapses for our point of view is anything more than 30%, right? From the Great Depression to the 2007 housing bubble, the markets tanked 19 times across the world, right? Germany, Japan, etc., all of these different places. If you took the average of those market collapses and put it against this slide, it looks almost identical. It's literally almost the same thing. The downturn there in this particular case was like 55%. The average is 54. That swing back up, not quite getting to the crest there, is that time period is almost exact. You do that little run through where it stays somewhere around what it was at before, about 3 years or so, and then the market takes off into a bull run. It's amazing how this looks at that. Not why we brought this slide up. The reason we brought this slide back is because, like it says on there, every single market, when that downturn and crash has occurred and the bounce back has come back, there's been, just like in an earthquake, an aftershock that has occurred. There's been that additional decline, and in this case, you see two of them pop up, right, where you had those aftershocks that were within a 36-month period. We are now cresting into, what is it, month 14 now, right, since the market bottomed in March of 2020. So we're just about 14 months past that market bottom. The last one, this is more dealing with, the craziness that's going on. So, margin debt, margin, you're investing with borrowed money is what margin is, right? But the idea with this is that the peak of margin debt was in the third quarter of 2008, when $402 billion of margin investments were out there. You want to take a guess what it is right now, where it was at the end of last year, at end of 2020, Craig? Try to take a guess where the margin debt was.
I would think it would be a lot less.
Yeah, actually, it's a lot more.
Really?
$482 billion in margin debt. We're probably higher today in where it is.
Oh, a risk out there.
There is a lot of risk out there. The percentage of equities owned by a U.S. household, the previous high, right, was in the first quarter of 2000, right, the dot-com bubble. 38.3% of household assets were in equities in the first quarter of 2000.
Wow.
Yeah, you want to know what it is? What it was at the end of the 2020?
Yeah, I do. What
38%.
going up?
No, it was 38.3, which is, but it's probably higher now. It's probably slightly higher now because we just set records in April. But that's the whole idea, that all of this money, all of the assets are in equities, like we talked about. Now it's being bought on margin. This creates issues and creates problems on grand scale when markets happen.
Have questions? Ask us. We can help with that. You can email Craig at crichardson@aresfoundation.org, or you can visit the website to learn more about what we do and how we might be able to help you. www.aresfoundation.org. Want to see more of this recording? Go to www.aresfoundation.org/events. If you know an organization or community support group that could benefit from one of our workshops, reach out to Tom T. Alessi at aresfoundation.org. Our mission is trying to help everyone have a better relationship with their money.